Alrighty, folks, we're going back here to the Diagnostic Trading Hour. And let's check out where the markets are at right now. We got the S&P is up 2.25 points. We have the Russell is up 0.10. Nasdaq is down 18 points on the day, with the Dow moving up 61 points right now. Going into our copper metal markets here. We got copper right now. It's pretty flat on the day. Gold is down 6 points. Silver is down a little over 0.5%. Hopping into the energy markets, we have natural gas is currently up about 1%, and we have oil is up 3%. So some monster awesome moves in oil today. Going on over to the FX markets, we got pound dollar is up 111 pips. So some huge moves there. We got euro dollar up 92. We got dollar franc down 59. US yen down 65. Euro yen up 34. Euro pound pretty flat on the day. Aussie yen down 14, Aussie dollar up 42. Bonds up big time. 3-year bonds up 1.1%, 1.17% on the day. So a big move in the bond market. And the dollar index moving on down at nearly 1% today. So King dollar getting a little weaker, but the bonds going higher at the same time. That yield going up. And we're seeing dollar be stronger on a couple pairs and weaker on a couple others. But overall, dollar is getting weaker today. Hopping on into the pound yen. On the pound yen, it is currently up just 13 pips. Pretty small move for the pound yen today. Euro franc is up 35. Pound franc is up 52. Dollar CAD down big, 106 pips on the day. And we definitely have some more news in our forecast. Going to be driving some more dollar CAD moves like we've been having thus far. Let me go ahead and open up. Give me 1 second here. I will pull up another chart on here, but I want to go over your top news stories for today. And once that's up, there we go. Okay, so a few things going on. ETFs are starting to see some of the biggest outflows they've seen in the last 15 months, oil ETFs. So people are starting to get out of a bunch of those ETFs. Big exodus is starting to happen right now. Oil is rising. I guess people are just going straight into it, but a lot of people are just pouring out of them. But I mean, sort of funny because they're doing it right as oil is like starting to fly back up. I think that happens a lot, right? So they're all hopping out because they're like, oh, I just can't take this ETF dropping anymore right as oil starts flying back up. Anyways, oil is rising as output drops and Middle East tension rises. Let's go ahead and take a look at that real quick. Got quite a bit going on today with that. But let's see here. So let me pull up the oil chart I had up a few minutes ago. And I'll just flip this one back over to oil. We'll do that. All right. So anyways, as all these Middle East tensions are going up, but everything that's happening right now, that itself is starting to drive the price of oil. Let's see here, let me just remove and then add back. There we go. But we got some pretty nice moves there. Let's see, what else do we have going on? I don't know why I'm having an issue. Let me check my instrument manager 1 second. I wanted to show you the deviation levels here and where we're at exactly on the day, because it's a pretty big move day. Hold on, I will get that updated. See if we rolled over already, or I just might need to do a reboot on the system. That happens. All right, so over here on CL. Yeah, I'm on the right contract. Everything's right. Okay. I'll just do a reboot here during commercial break on my platform to get that fixed up. Okay. We'll go ahead and hop on. We'll come back to oil in a little bit. European stocks in mostly negative on the day. So, overall there, a lot of times that can be a precursor to us ending negative on the day. We'll see if that plays out. But going on in, Eurozone misses, output, and CPI is down a little bit as well. So major European markets, Europe global equity markets, and you can see basically the percentage down moves by category there. So I got you updated on the European side. Pound yen rebounding from the 6-month lows and erases a bunch of their losses. So pound yen is a fun instrument to trade. And I sort of like it when it's making new lows. But it erased those lows, bouncing up pretty big. Right there, just like flying off of the bottom of that. Let me load up this Forex data chart. I'll show you. And let you see exactly what I'm talking about. But very impressive move, and just a great instrument to trade overall. Like I said, it's one of my favorite instruments. It's pound yen because you get the good volatility of the pound and the good volatility of the yen, especially whenever like yen is doing something, because pound's always moving pretty good. Okay, so or not always, but I mean most of the time is actually a pretty great pair all in itself. But whenever Japan's doing any kind of monetary policy stuff or whatever, I mean that really can just basically adds volatility to volatility on top of it and makes it even better. And I don't know what is going on. It's like an unresponsive page. A couple things there. Probably just need to reboot. All right. Dollar is sliding on retail sales. Disappointing when euro and gold outflows. So dollar going on down off the retail sales numbers. Not quite meeting investors' expectations. All right. So we got a few rolls that are happening this weekend, okay? So a few rolls that are happening this weekend that you want to make sure that you have, ready and in your arsenal to go. One of the things is after the close on Friday, we're going to be looking for if you're Nadex trading, okay? If you're Nadex trading, so if you're trading on Nadex, then what you're going to want to do is you're going to want to go in and you're going to switch over 3 contracts this weekend. What 3 contracts? Okay, well, if you have the scanner, it's helpful, but if you don't, then you'll see it whenever it pops up on the weekend or, right here on the radio show. You're going to be looking at corn, you're going to be looking at soybeans, you're going to be looking at oil. Okay, so you're going to be rolling over those contracts to the new month at the end of the week. Now, we have that built in for you in the scanner, okay, because we have a little information section that has a calendar and it shows you. So really Thursday at 6 p.m. we're gonna be rolling over corn and soybeans. All right, so Thursday at 6 p.m. rolling over corn and soybeans, and then Friday basically after the close we'll be rolling over crude oil. So whatever date shown here, it happens at 6 p.m. the night before. All right, so at 6 p.m. the night before is when we're actually doing that roll. So make sure you get those updated. Of course, the following will allow the natural gas rollover as well. Now, you need to be aware of Nadex rolling versus the CME rolling. Some of y'all are trading Nadex, some of y'all are trading the CME. Some of you are doing a little bit of both. To know CME, you need to look at the actual, are the traders rolling? Because Nadex will stamp, say roll, boom, all contracts will say that month in them whenever you use them. The CME, they may announce a roll date, but it doesn't matter until the traders themselves choose to roll. So I just watch the volume. It's pretty simple. So if I go over to cmegroup.com, I go to trading, I go to energy, and I scroll down a little bit to crude oil futures. Okay. Click on quotes, and I'll see where the volume is. Right now, the volume is on May. But you can see June is quickly picking up, 106,000 contracts versus 245,000. This number will get larger and larger and larger, okay? When it exceeds May, that's when the roll has officially happened, okay? So when it exceeds May, then that's when it officially happens. So I usually stay, if I'm trading futures, I just stay on the May contract until I see June actually get larger. I don't worry about if it's Thursday's the official roll date because you get some announcement in your platform or from your broker. When the volume's higher, I'll move. Okay? So often results in me moving like on a Monday because like Thursday, like I say if it's a Thursday roll date, like often you'll start seeing the volume will get, pretty on par. Friday, it sort of start off slow, but then it'll like usually exceed it by the end of the day. I'm like, okay, now it's exceeded. The day's over. Boom, let's go ahead and flip over. Okay. So usually I end up like rolling over like on Mondays, whenever there's like a Thursday roll. But if you want to get real fast, you can do it. I don't like doing it on the day of roll, and usually I don't even worry about it the Friday after. Okay, but you know, you can go either way you want to. But if you're trading Nadex, you roll 6 p.m. before that date. Okay, so like on Friday at 6 p.m., then update. When I say roll, it means update your chart. If you're using Thinkorswim, they use an auto roll feature, but they're not always right. So you need to be able to enter your month codes. What month code should it be? Okay, so like on Thinkorswim, be like /CLM5. So it's a roll to the June 2015 future. If you're in Ninja, you need to go into your instrument manager and update it from CL05-15 to CL06-15. Okay? So, you know, those are basically the two main formats of either using a numeric or a letter-based month symbol. And that's how roll works. While talking about CME, you know, let's go in and let's look at some of the volatility indices. Let's talk about those for just a second. That's really not CME related, but just in the sense of, you know, while we're, you know, over there on TOS, we can go in and we can pull up, you know, some of the volatility indices. We got the VIX, checking this out right now. And I've went over this before on one of my previous radio shows. I went in and talked about all the different little volatility indices they got. And it's pretty easy. You can go in here and click on here and click, remember, the volatility indices are on the CBOE. They're not on CME. But let's see here. If I go to look up, and I can just type in the word volatility. So, volatility. All right. And then I can say index. Let's see if they label them all the same. And they're really not getting me just index. Well, I got one of them on there. They give me the RVX. Okay. So there's the Russell Volatility Index. And I need to put it on a daily chart. Let's see, we'll go back. There's our Russell Volatility Index. We'll sort of see where the IV is, the implied volatility is. I can go over here to OVX. You're an oil trader. Okay. Maybe you're a gold trader. GVX for the gold volatility index. And I'll tell you how to use these a little bit more when we get back. All right, folks, welcome on back here to the Diagnostic Trading Hour. And we're going through, we're looking at a few different things. Let's see here. Let me update this one. Okay, there we go. I just want to get all my little news plans updated, ready to go. Okay. And putting all that in for you so that way we can pull it up and walk through it. Before we dive into the news, to wrap up the volatility indices, there's a whole list of these that you can check out. And they're real easy to get to. Just hop on over and just type in CBOE, okay? And then you can just Google CBOE volatility or CBOE volatility indices, and you'll get a whole list of them. And they got ones for, you know, obviously the S&P, the Nasdaq, the S&P 100. We got the Dow Jones. We got the Russell. You can also go down. You got 10-year Treasury notes, interest rate swaps. You got Amazon, Apple, Goldman Sachs, Google, and IBM. You got the VIX on the VIX, which has some pretty crazy, cool things you can do with it. But you got stuff on, you know, oil, on gold. So there's a lot of different markets you can check out, and it basically lets you know is volatility, you know, low or high. And when volatility is low, then we expect premium to be cheaper. When volatility is high, we expect premium to be, you know, more expensive, more inflated. And so we can use strategies that take advantage of low premium when volatility is low and high premium when volatility is high by looking at those and knowing what's going on. Also, we can see what the market's expectations are for movement from day to day and sort of seeing like where they're going. It's like, okay, well, volatility is dropping a little bit on the S&P. It's dropping a little bit on, you know, the Russell. Let's see here. If we put this over to dailies. It's a little low on the Russell. We should see it go down, by the way, when the market goes up. Volatility is increasing a little bit. Option demand is increasing some on gold. So there's a little more volatility expectation coming in. It dropped down, but came right back up, had a big week day. And so you can start seeing that. You'll start pulling it back. And like I talked about, putting moving averages and everything on there. If you go back and watch the show I did a couple weeks back, where I dove into the volatility indices and how to use them, they can help you know what kind of binary strategy you want to focus on. They can help you know what kind of option, just standard, vanilla option strategy you want to focus on, what to expect, whether you want to be trending or whether you want to be scalping. So a lot of cool ways that you can use the volatility indices, okay? And let's see here. What else do we got? Let's see here. Going into this is a new announcement that's coming out. Put an article out on this the other day. But let me see if I can pull it up for you. And had a few questions on it, so I figured this would be a good time of the show to cover it and what's happening there. Let's see. Let's see what we got. Going on over here. Okay, so ninjatrader.com. Okay. If we hop on to Ninja Trader, they are now offering Forex as well. So they offer futures at like 53 cents a contract, okay, which is awesome. And they offer FX at basically 0.04 cents like for a mini lot, so 40 cents for a lot, okay? So if we go over, let me show you how this works. What does this mean? One, if you had Ninja Trader for your futures broker, and you had Ninja Trader for your Forex broker, you'd only need a single broker license to be able to trade both. You wouldn't have to buy a multi-broker license, okay? Which is nice. And then you would have two accounts. You would have a futures account, and you would have a Forex account, okay? To go in and look at, what are their costs, what are their rates. So if we go into, let's look at the available markets. They show you the round turn. So if you buy a single broker license, which means you have it for life, okay, including all updates and everything, like E-mini S&P round turn, $3.40. So that's them charging you 53 cents. And then basically the exchange fees are $1.16 each side, and the NFA fee of a penny on each side. Okay, so $3.40 a round turn, not bad. So we'll cover this so you understand the commission fee on futures. Then we'll talk about how it works on Forex and all together. Stay right there. We'll be right back. All right, folks. Welcome on back here to the Diagnostic Trading Hour. We're looking at the Ninja Trader brokerage that now has futures and Forex. Looking on over here at the lifetime contract. If you buy a lifetime license, they give you the largest discount. So I don't know what you're paying right now, but it's probably not $3.40 on the S&P futures. And you go down here, Nasdaq $3.40, E-mini $3.80. Okay, or 380 right there. Yeah, 340 also. So gold futures, 398. Let's see, crude oil futures, 398. I mean, not bad. So 340 to 398, a round turn, and that's every fee: exchange fee, NFA fee, clearing fee, broker fee, all inclusive round turns. They list them all over there on their site. So you can trade futures directly through it, and you also can go in and, like I said, they have the Forex now. So if we go over here and we check out Forex, let's see here, and let's go in and look at the spreads on basically what would it cost. You're looking at a 0.2 pip spread, 4-cent commission fee. So if you own it, so 4 cents, 0.2. And as an example for you, how would that work? You'd add the round turn plus 0.2 pips, so 10 cents. So your round turn transaction cost would be pretty cheap. Going in and going out, you'd be looking at basically like 10 cents on a mini lot, which is equal to a pip. So that's getting in, getting out, all fees included, like a pip, say on like euro dollar. Okay. And that's including everything. Again, bid offer spread, entry exit, commission fee built in, because the bid offer spreads are insanely tight. like they're at like 0.2 pips. Okay. So obviously putting all that together adds up. So 4 cents times 2, and then plus a 2-cent bid ask spread, which you only pay one time, obviously, would equal 10 cents. Anyways, but you can go over there, you can trade them, and it's really cool. One of the things they did that I think is unique is they actually laid out the margin. Instead of just saying the 50 to 1, you know, like in your majors and, you know, you're like, you know, 25 to 1 on your exotics, they actually listed what would be per 1,000 units of currency. So if you do like 1,000 units of your dollar, then your margin would be 28 bucks. Now you're only going to make 10 cents or lose 10 cents a tick, okay? So you're probably going to want to be doing like a mini lot unless you really are just starting off. A mini lot would be 10,000 units. So then you'd be looking at 280, okay, to put up in margin. If you did a full lot, you'd be looking at 2,800. Anything U.S. based, 50 to 1, you're going to be putting up 20 bucks, so or $200. And now basically the whole point here is that what I want you to understand is you can trade Forex now at Ninja Brokerage. You could have futures account at Ninja Brokerage, you can have a Forex account at Ninja Brokerage, and you can have a single broker license there and have really low fees and low cost. So anyways, check them out. And they also have great customer service, so they can help you out on that. Some of the questions you know, that come up are, you know, about this is, well, what is the advantage of trading spot FX over futures FX? Okay. So spot FX over futures FX, and the big advantages on futures FX are that you're on an exchange. Okay, so there's no possible kind of party stuff. Now FXCM is basically ECN, even though they may countermatch. Basically, you know, ECN type FX, and passing it through. Your lots are always going to be 125,000 units, like on 6E, or 100,000 on 6A. You can do 1,000, 10,000, 15,000, 30,000, you know, whatever size you want if you do spot FX. Futures FX will include the what's called carry interest rate. Like if you're long Aussie, short dollar, you know, then you know, you'd be going in and you'd be collecting interest rate on Aussies, and you'd be, you know, paying out the interest rate on the dollar. So you'd be collecting a little bit of carry over the course of every night. There'd be either an adjustment to your position made or carry interest calculated in. If you're doing spot FX, they're actually going to adjust it. Futures FX, that interest rate is already built into the price, so you don't have to worry about interest and carry and all that. Spot Forex doesn't change from intraday margin to overnight margin. It stays the same. FX margin, you know, you get that intraday break at, you know, you'll basically around a 10 to 1 of what the overnight margin is what you'll get during the day. And then it'll go up past, you know, like 5 o'clock or past the CME close. So as soon as CME, the Globex, does a close session, it'll pop up and you'll have that. Now you'll have that holding margin if you're holding it. I'm just trying to go through like each, like, you know, what's the two things on each side. So you got the carry interest that you have on spot FX that's already built into the futures. You have the varying margin, day trade margin versus, you know, initial margin, you know, open margin there that you have on futures. You don't have to worry about that on spot FX. And let's see, you can do various sizes on spot FX where you're basically locked into the contract size of 125,000 on futures FX. They do have micros and they do have minis on the futures FX, but they are lower liquidity. So you're going to pay a wider bid offer spread, and you're going to pay commission on top of that. So it really does not behoove you at all to trade micro or mini, you know, FX contracts on the exchange. You're better off just trading spot. If you're going to trade micros at all, my personal opinion is just to hop over to Nadex, because the margin's about the same. To do an end-of-day spread, that wider spread, your margin is going to be about the same as spot FX. You don't have to worry about interest rates. And your bid offer, like a tick, couple ticks, no big deal. And you don't have to worry about flash crashes. And you can do sizes, you know, and every tick's $1, so you can do 1, 10, 20, 50. There's really, to me, it's like the best way to do it if you're doing, you know, especially if you're doing minis. But let's see, is it, and I mean, the one big thing, Nadex and CME are exchange-based versus OTC. So That's really, the pros and cons of exchange versus spot. So there's not, you're not really making a horrible choice either way, as long as you go with a CFTC regulated exchange or an NFA regulated Forex broker, like, NFA regulates, Ninja Trader, etc. Ninja Trader Brokerage. So CFTC, of course, regulates CME, regulates Nadex. Don't go like some of these overseas brokers. That's where I'd be really uncomfortable with. There are some other good ones. There's ones I haven't had an account there, but MB Trading I've heard is good. Obviously, eSignal is awesome. Thinkorswim is great. It all comes down to what you're looking for. If you want those tied commissions on futures, that's one of the big benefits of Ninja. Also, very low margins. So like a 10% of initial margin for day trading is nice. And we just go on down the list. There's so many comparisons I can give you. But that gives you a nice summary there. One of the things I want you to see is $0 like 28 bucks. So what if I wanted to go in and over on Nadex, okay? And let's see here. Hold on one second. I didn't mean to go there. I need to go directly. Here we go. Over here onto the scanner. And we go in. Let me pull up the $0. Okay. And just say, you know what? I want what contract do I want to look at? Okay. I'll say, well, I want ones that are within, really I want 5, I want to say 10 ticks of the underlying market. Okay, that's immediately going to shorten a lot of stuff down. And then I can say, I only want stuff that's like, basically end of day. So since it's so late in the day, I can just say 60 minutes at the moment. And then that's just going to give me a couple choices, okay? Well, obviously, I don't want stuff that's only going to make $5. So why don't I go up here, and here's the rule of thumb I've learned, all right? Let me pull this up in Excel, and I'll show it to you, okay? So very simple, helpful tip. Let's say it's, let's say the bid offer, or not the bid offer, the floor to ceiling is 100 pips wide. Okay, so spread, width. All right, 100 pips. You're basically going to get optionality in that first 30 pips and the last 30 pips. Okay, 30%. So like optionality. Okay. That middle 40% basically mirrors the market. Okay. So understanding that, and let's say I'm buying like somewhere in the center, then ideally I want there to at least be, I want to really be able to take advantage of this 40% right here. Okay. So let's go over here and look at these and go, why would I want the wider spread? Well, 100 pips wide, I basically, as soon as I move up about 20 pips, I'm going to hit optionality. The thing's going to slow down. Okay? But look at this one. That's pretty freaking fantastic, actually. It's only 4 ticks from proximity, $19 risk. Okay? $229 prop potential. So it's going to pick up pretty fast. But if I'm in that middle 40%, here's your ideal spread right here. That's the best spread. Okay? Out of all the spreads. Now, this is if you don't want to use a stop loss or something. But if you want to just use a simple, normal trading like FX, $, $200, controlling 10,000 units. That would cost you $280 if you were doing 10,000 currency units, which would be $1 pip. Okay? So it's $80 less. You're in that middle 40%, right? So what do I mean by that? Well, if I go in here and I say, okay, well, let's do the same thing. We got 600 pips wide. Okay? So what's that times point, we'll just say 3. So 180 up, 180 down. The middle of that is, let's see, we got that. Put this formula in here. What we'll do is we'll say that minus this plus this. That's going to equal our middle pips there. So if I can get that right there, if I can get it somewhere around 180, 200 bucks, that means I got a couple hundred pips, like 240 pips of movement in my direction either way. Okay, I mean, I could just buy or sell this spread all day long. That's the only spread I even need to use without having to run into optionality. I only need that one spread all day. By the way, that spread started at 6 p.m. last night. So when I say all day, I mean all day. There's only one spread I need, and I can trade with that one spread all day long and not worry about optionality, not worry about what's the right spread, and I can trade just like I'm trading the Forex market or just like I'm trading the futures market. Obviously, if I want to do size, I can do 10 to make it like a full lot, okay? Or 25 to make it like a euro dollar 6E future, okay? Notice the proximity is only 2, which really doesn't matter until you get to expiration, okay? So don't even worry about proximity as long as it's lower than really 5 to get to expiration. So what are some of the tips? How can you do this? Well, you really need to look at each contract, because if you can't just choose a minimum profit or you'll sort of mess yourself up. But we can do, like, say I want a proximity of 5, -5 to +5, okay? And then let's see, what do we need to do? We can go in here and say, well, those last 180 pips aren't going to help me that much. So how can I sort of rule those out on that super wide one or whatever? But I can go in and go, well, what my risk reward ratio? If I say 1-to-1, that's too tight. So let's say I say 0.5. At least I get rid of the really stupid stuff, okay? Over here, so now at least I have stuff that, potential, like these 4 potential possibilities. So a very simple way is just to go -5, +5, 0.5, and then I want to get rid of the ones that are expiring later in the day. So I want to go, there were ones that aren't expiring until the end of the day. I only want to see like 3 o'clocks. So I will have to adjust this as time goes on, right? So if I leave it on 60 minutes and at 6 o'clock, well, I won't see the ones that expire at 3 p.m. So you'll need to adjust this occasionally as time passes by. But those are the only contracts that are an option. This one is the best option. It has the closest proximity, has the most profit potential. Now, if I don't think it's going to move more than 50 pips, I could use this one, okay? This one and that, basically those 3 are the same. If I don't think it's going to move, but if I'm wrong and it takes off, then, hey, I miss out on a lot of profit. And there are times it does take off. This one will move a little bit slower, and then it will speed up. But since we're so close to expiration, that's why that proximity is so low, that you'll see it move more like at an 80 or 90 delta, but then it'll pick up pretty fast, and then we'll close out, be able to go in and use this one though all day long, which I think is what makes it easy. If I can just buy and sell that contract all day. All right, stay there. We'll be back right after this break. All righty, folks, going back here to the Diagnostic Trading Hour. So I basically was going over, hey, here's how you do futures, here's benefits of futures. Here's how you do Forex, here's benefits of Forex. Here's how you do Nadex, here's benefits of Nadex. And I know so many people will just shy away from the spreads because they don't seem as cool as the binaries. Or they're like, I'm just going to stick with futures, or I'm just going to stick with Forex. So, or they come in incorrect because they have this whole binary mindset of it's all or nothing, and it's like they see $200 risk, and they're like, "Whoa, that's too rich for my blood," because they like risking like $40 a contract. I'm like, well, if you're getting out with a stop loss of 20 or 30 or 40, it doesn't matter what the max risk is. I mean, crap, on a future, the max risk is $140,000 value down to 0. Okay, it's where you get out. That's your risk. Okay, that's just your worst case risk. So just, go in, use a stop plug in, and hop out if it moves X ticks against you. Trail your stops. Well, how do they work on profit and loss? How do I figure that out? Well, if you buy at one price and you sell at another, the difference between those two prices is $1 per tick. They always tick in increments of whatever the last digit is. So the last digit is 0.1, they tick in 0.1. If it's 0.0001, they tick in 0.001. If it's 1, like the Dow, it ticks in 1. Subtract the entry price from the exit price, divide it into a whole number, okay, like divide it by 0.1 or 0.001 or whatever, multiply that times $1. So how many ticks did you get? I made 25 ticks. Well, you made $25. I lost 10 ticks, you lost $10. Very, very simple, okay? Like it's easier to trade than binaries. It's actually not even hard to understand if you'll focus just on those end of days, doing that close proximity like I teach, because you'll get rid of the optionality. So you can wipe out the optionality, you can wipe out the complexity of choosing expirations. You can always just choose like one contract to buy, one contract to sell, pretty much for most of the day, if not the entire day. And so when you're buying euro, you buy this one. If you're selling euro, you sell this one. If you're buying Russell, you buy this one. If you're selling, sell this one. Okay. So, and that right there is my summary for spreads. But I mean, you need to. We'll go back. I think I might start doing some reviews on spreads and really helping you learn how to pick these spreads. But they're pretty simple. I mean, if you get down just to what I'm saying, what I want is I want that wide spread. I don't care if you have a $500 account. Okay, you can open it. It's $200. All right. Want that wide spread with the close proximity. What if I'm trading oil or Russell? Let's look at Russell. Okay, I want that wide spread with that close proximity. See, I mean, 70, 200, 300, 500. That makes it real simple to worry, doesn't it? I want that one. That's it. Okay, that's the spread I want. Now, you could choose this one if you really wanted to, but more prop potential. I'm going to go with that one. Okay. Remember that whole thing I said, like top 30%, bottom 30%, optionality kicks in? I want to stay out of that zone as long as I can. I want that full throttle speed ahead. What if I'm trading oil? Okay, let's look at oil. It's closed, so can't trade it. Well, it shouldn't be. Oh, there may be nothing that qualifies right now. Man, it moves so much. Let's see. Where's our wide spread? We gotta have something. There we go. I don't know why. Oh, because I had that percentage thing in there. Well, see, our proximity should match. So if we say -5, maybe it just took a while and I wasn't patient enough. So 5 to 5. Okay. And then let's go in and say that risk-reward ratio, again, is at least, what do we say, a 0.4 at a bare bones minimum. Okay. And then just find that wide spread. You can do the 500 or 1,000, by the way, on this one. $340. Put that up, risk $30 or $40 in the trade. Trade $1 a tick on oil. Okay. Proximity of 0, 1, 2. Easy. All right, we'll keep going. We're going to go over this again more on Thursday, so make sure you tune in then. Y'all have a great day.